Good evening, everyone. Thank you for joining us today. Apologies for not conducting this on the day of the policy due to unavoidable reasons. We had to schedule it for today. Nevertheless, it's our privilege and we are very happy to have you here. If at any point our voice is not clear or you can't hear us properly, do let us know in the chat box. Let me begin with a summary of what happened in the monetary policy review and also importantly, how we are thinking about macros and markets over the next few months. So as you know, the RBI MPC kept all rates on hold as was broadly expected. However, it was a good policy from the bond market standpoint because the communication accompanying the policy was decidedly dovish and constructive with respect to the possibility of at least one more rate cut in the future. So the RBI governor acknowledged the fact that even though growth so far has been strong, but there are risks from the external side on the horizon. And if you see the official forecast of the RBI, even though because Q1 real GDP was 7.8%, they had to automatically lift H1 real GDP. But H2 real GDP forecast is now lower than what it was in the previous policy forecast. With respect to inflation, they have acknowledged that post the GST rationalization, inflation is substantially undershooting what they had initially forecasted. And there is a 50 basis point odd haircut to their inflation, average inflation forecast for this financial year. And for Q1 next financial year, there is a 40 basis point haircut to their initial forecast. So broadly speaking, now the RBI expects next financial year inflation to be also of the order of around 4.5%. This year is much lower. So there is now an explicit acknowledgement that there are some risks to growth from the external side, that inflation is lower than what they projected, and hence, as a combination of the two, the RBI MPC governor have explicitly acknowledged room for further monetary easing. Although they have skipped this policy because they are waiting for transmission to happen fully of previous rate cuts and also recent fiscal measures taken, most chiefly the GST rationalization, but also previously cut to income taxes. Those they also want to see how they are impacting GDP growth rate. Importantly, also, and although the Monetary Policy Committee does not vote on stance, but two external members basically wanted stance to be turned back to accommodative, thereby signaling that probably in their view, there is scope for further monetary accommodation. So, all told, it was a bullish bond policy, and it should especially be looked at in the context of the June policy, which had first triggered the sell-off in the domestic fixed income market. Because you would remember in the June policy, the RBI had abruptly changed stance from accommodative to neutral. Now, as we and other market participants have said since then, the expectation channel is an important channel of transmission, both to the bond market and to the financial economy in general. And by changing stance to neutral, the RBI had effectively communicated to the bond market that please don't have any future expectations from us, which had a detrimental effect on bond yields. So, one of the clearest ways to look at the October policy is that the RBI has unwound that communication of not of or communicating to the market that please don't expect anything more. Now they are saying that you can look forward to further monetary easing, and that's a very, very important channel for the bond market to perform. More broadly, it's an important channel for transmission to the general financial economy as well. Alongside, the RBI has also undertaken further measures or proposed measures to facilitate the flow of credit in the system. And one of the things that the governor said, which has stood out for us, is that he believes that there has to be coordination between monetary policy, regulatory policy, and fiscal policy to achieve India's medium-term goal of Viksit Bharat. So that is the context of policy, and in that light, let us just look at where the markets are at and how the next few months are looking. So first of all, what is the source of RBI's uncertainty with respect to future growth? As we all know, it chiefly emanates from the tariff uncertainty, which is the higher average goods tariff that the US has levied on India. More recently, there is the charge on H-1B visas, which on the margin is detrimental for the services sector, although to a very small extent. And third, there is this bill being debated in the US, which the probability of passing is very small. But if it were to pass, it will levy a 25% or so uh, charge on export of services as well. Now, as you know, US is a very important export partner for us for goods, but also it's a very important source for services as well, or source of export of services as well. And to refresh our memories, even though India runs a trade deficit on the goods side, it runs a services trade surplus. So on a monthly basis, India runs a 15-16 billion dollar services trade surplus, and it's a very large source of both income from abroad as well as compression of our current account deficit, and has ancillary benefits in terms of, let's say, things like employment creation, real estate demand, and so forth. So clearly, and like I said, although the probability of that bill passing is very low, because it will also impact large US companies who are offshoring services to countries like India. But if it were to happen, then that is a source of impact that RBI has to be cognizant about. So in summary, the RBI has acknowledged that there are uncertainties, external uncertainties with respect to the growth outlook. And given the leeway being provided by lower inflation, they stand ready to act. And that is really what the bond market was looking for from them going forward. Now, how does it impact portfolio strategies, and what looks good in the bond market and what does not look good? Let's just do a quick recap of what's been going on over the last few months. So like I said, the abrupt change in stance in the June policy led to effective severing of expectation channel for the bond market, and it led to an across-the-board sell-off on yields, a rise in yields, which was very curious, frankly, for this phase of the market, because over the last few months, you have seen a slowdown in credit. So banks have had excess deposits, which ordinarily they would have deployed into investment books, including SLR, but they were largely sidelined, partly because of bond market volatility. You have had falling inflation, but the bond market has been immune to that. Uh, and you have been seeing relatively benign external interest rates, but bond market has been largely immune to that. So since June, basically the Indian fixed income market has struggled. Volatility has been larger, even though on the face of it, a lot of things were working in favor from a macro standpoint. However, with the October policy, that part of the irritation for the bond market has been removed. Now the policy communication is basically suggesting to the market that there is further monetary easing on the table. Our own view is that RBI MPC probably cut in December by 25 basis points. And if the impact from external uncertainties is not very heavy, then that is where the terminal rate for repo will be, which is 5.25%. There is also a good chance that in Q4, which is the Jan to March quarter, the RBI undertakes some OMO bond purchases. And that is partly reflecting the fact that currency operations have restarted. Rupee has recently been under pressure. So RBI has had to step in to defend the currency. That, combined with a rise in currency in circulation over Q4, may very well require, let's say, a 1 lakh crore plus minus OMO purchases from RBI as well. Now, again, looking at the last few months, so one source of problem for the market has been RBI commentary, which has now been rectified. However, another source or problem for the bond market has been excess supply of duration. So the center's supply calendar has been skewed towards more long duration for the last 1.5 odd years or 2 years. However, over the last half year, we have also seen states' average maturity of issuances rising. Now, that has been partly rectified by the center changing its borrowing calendar. So around 6% of long end has been redistributed to the short end and the 10 year. However, state calendar is still awaited, and one still needs to see how much of adjustment happens over there. However, generally speaking, the framework that we are operating with respect to the bond market is as under. So the first big point we are making is that it is too early to position for end of cycle. So we've also heard commentary from the market that there is nothing left in the bond market. You should just move to 1 year, 2 year, 3 year carry rates and be done with it. We disagree with that point of view. We think there is enough on the table left in the bond market not to already think of it as end of cycle. In fact, like I just elaborated upon, there is reasonable likelihood that if global growth uncertainties were to rise, there is ample scope for monetary easing. Our base case is 25 basis, but if the extent of those uncertainties is larger, then it could even turn out to be 50 basis points of rate cuts. Against that, bond valuations are actually quite cheap. So if you see where various aspects of the bond market are at, yields are actually quite well poised. In fact, over the last few months, because of excess supply in the bond market, there has been an across the board sell off. So not just the long end, but even the 5 year point, which has been a favorite for the bond market in a rate easing cycle, has suffered quite a bit of a sell off. So as of yesterday, as an example, even the 5 year sovereign bond was in the vicinity of 6.2%. The 10 year was closer to 660. There has been some rally since then. So the first big point is it's too early to position for end of cycle. There are still plays left in the bond market. There is still mark to market gains to be made in our view over the next few months. However, point two is that the phase of the blunt participation, that was to maximize duration and just participate because there was large scope or meaningful scope for fall in yields, is probably also over. So from here, one has to be a little more nuanced. One has to respect the shape of the yield curve and how you think the yield curve is going to progress going forward. Because, like it or not, there is an issue of supply of bonds, and a large part of that issue is actually coming from states. So state average fiscal deficit has now moved up to around 3.2 to 3.3% of GDP, which roughly translates into, for example, for this financial year, a gross issuance calendar for the whole financial year of close to 11.5 to 12 lakh crores. They have done 5 lakh crores so far over H2, which is October to March. Therefore, they will have to borrow another 6.5 to 7 lakh crores in our estimate. The center will borrow something like 6.75. So all told, you are going to see almost 13.5 to 14 lakh crores of gross supply over the next 6 months, which is reasonably large for the bond market. So that basically puts a certain amount of floor to the long duration part of the yield curve, even though the top of them may have already been seen. So the point we are making is that the recent sell-off in duration is probably over. There is some bit of a cap that may be formed on even long duration bonds going forward. But because of the large supply that is still ahead of us, the floor on these bonds is probably also moved higher. However, combined with that, the bond market now has the proverbial carrot of further rate cuts. And our sense is, and we are already seeing that over the last couple of days in the market, that there are certain segments of the market where pricing is quite attractive, and let's say bank balance sheets, investors, etc., are coming back. So largely, if you see the 5 year plus minus segment, that is where the interest is recropped, and because valuations have become very attractive, a lot of investors are probably going to start to come in into that segment. So the other part of the view is that rates will fall. In our view, bond yields will fall, but the fall may not be very large unless growth rates become very, very strong. And as yields fall from here, the yield curve is likely to steepen. So just as you don't want to already say that we are end of cycle and position only in passive carry, you also don't want to go overboard with maximum duration participation, because we think unless there is a sustained addressal of the excess supply, the floor on long duration bond yields has moved up. And as bond yields fall from here, there is a chance, a very strong chance, that the yield curve steepens. Reflecting this view, we have changed positioning in our active duration funds. We are now overweight 6 to 9 year government bonds, and most of the rest is only up to 12 years of maturity. We believe this is a good positioning to participate in an optimal fashion going forward in a market where we think there is still reasonable scope to benefit from fall in yields. At the same time, one is not looking for very dramatic moves. And as yields fall from here, one is also looking for some sort of a steepening of the yield curve, which in turn will reflect two to three things. First is the carrot of rate cuts is back on the table, and the natural place where most investors play the rate cut is from the 5 year plus minus segment. Second, the large amount of supply, especially owing to SDLs, will probably put a higher floor to duration part or long duration part of the yield curve. And third, which is still evolving, is that, see, first of all, one has to understand that the government is very responsible as far as fiscal consolidation is concerned. They are first and foremost very conservative with respect to macro policy. That said, the phase of progressive fiscal consolidation is probably ending with this financial year. From the next financial year, the government moves to the debt to GDP framework. So, to recap, what they had said is they had said we will progressively bring debt to GDP down, and they had an explicit fiscal deficit target till FY26. Post this, they will basically manage fiscal deficit in a way that the debt to GDP for the country is progressively reducing, which means that for a year or two, if they want to take a bit of fiscal expansion, let's say by 20-30 basis points, they can do that. And there is a chance that for the next financial year, they will want a 20-30 basis point fiscal leeway, given a couple of things that is happening. First is nominal growth rate for the country has slowed. So as you know, although real GDP is strong, nominal growth rate is around 8.5%, and that is showing in government revenue collections as well. So if you see year-to-date tax collections, both direct and indirect, they have slowed. The total government receipts are being buffered because of previous excise tax hikes, as well as higher dividend from the RBI. But more and more from the revenue side, there is some slowdown. And if the pressure on the real economy rises because of external uncertainties, then the government will be well within its rights to undertake some modest fiscal expansion to basically backstop the slowdown in growth. And that is very consistent with being responsible macroeconomically as well. So, there is a chance that the best of fiscal consolidation is behind you, and the next financial year sees a marginal expansion in deficit. However, for the bond market, it is always the direction of travel that matters. And if the phase of fiscal consolidation is flatlining and then partly rising, then the bond market also starts to perceive that probably the phase of playing duration is starting to get over. The second part also is that if the global uncertainties were to be larger, then, like I said before, probably RBI has room for 50 basis and not just 25 basis. So if you see a combination of these two, which is a marginal expansion in fiscal deficit alongside a 25 to 50 basis point rate cut, that also argues for slightly steeper yield curves. Which brings me to the next point with respect to bond market strategies. See, it's ordinarily felt that the steepness only is in the long end. That is not true at all, because again, if you see the last phase of the bond market sell-off, it has been across the board sell-off. So it's not that just the long end yields have risen. Even a 5 year yield has risen, 10 year yield has risen, 15 year yield has risen. And again, referring to yesterday morning, because things are changing since yesterday morning. Yesterday morning, you had a 1 year treasury bill roughly at 5.6%. You had a 5 year government bond at 6.2%. So there was a 60 basis point spread between 5 year to 1 year. You had a 10 year at 660. So there was a 40 basis point gap between 10 year and 5 year. And you had a 30 year at 720. So there was a 60 basis point gap between 30 year and 10 year. So you would see that the entire yield curve is steep. It's not just the 30 year that is steep, but the entire yield curve is steep. And therefore, there are a lot of duration adjusted plays which are quite lucrative on the bond yield curve without taking a very, very large duration risk, such as what is offered at the long end of the yield curve. And that's the point we are making, that as the market is now getting more convinced, as the RBI has opened the door for further rate cuts, there are some more lucrative parts of the yield curve, which is 5-year plus minus, that have started to make more sense to a lot of investors. And we are already starting to see those points move on the yield curve. And that, I think, is a good way to participate for a lot of investors. So the other point associated with that also, and you can see that in funds flows into mutual fund over the last few months, since June, as bond markets had turned more volatile, you are seeing flows largely restricted to the very front end. So overnight fund, liquid fund, to some extent ultra short, low duration, and money market funds. Probably with this green flag that RBI has given for at least one more rate cut, and if global uncertainties climb, maybe two more rate cuts, you will start to see investors coming back into short to medium duration strategies as well, especially given that over the recent period, valuations on those have become quite attractive because yields have risen. So that is, the lay of the land as far as domestic policy and, the macroeconomic trajectory as far as we can see it. Just a quick word on the external economy. So the US has distinctively slowed this year compared to last year. However, there are various pieces there that demand a bit of analysis. So, one way to characterize the US is it has today a frozen housing market and a frozen labor market. So the housing market is frozen because prices have climbed. Therefore, a lot of the market has become unaffordable. Supply has on the margin reduced, and mortgage rates are high. So people cannot exit the current mortgage and refinance with a new one, because suddenly the jump on the rates they have to pay will become very large. So you are anecdotally seeing more and more issue with mobility. So people are not able to move from smaller homes to bigger homes, or change locations or stuff like that, and which inherently therefore is an unhealthy housing market, and a housing market that is in disequilibrium. Similarly, if you look at the labor market, and this is something that the Fed is now getting more and more concerned about, although the unemployment rate is still relatively low, both hiring and firing have become very subdued. So basically, it's a market which is stuck where it is. People are not fortunately getting fired much, but unfortunately, they are also not getting hired much, which means that whoever is losing a job is finding that much harder to get a new job. New entrants to the labor force, which is people who are graduating, are finding it much harder to get a job. So the graduate unemployment rate has risen very substantially. And again, just like in housing, your mobility has been cut out, because you can't exit this job and go to a new one in another city, another sector, etc. At least it's not that easy to do it. And this is something that the Fed is now getting more worried about, because in a scenario like this, if companies were to start firing more, then the unemployment rate can quickly rise. The third aspect, which requires a bit of attention in the US economy, is that the aggregate economy has slowed, but there also a lot of capex is being held up by AI related capex. So, there is, people talk about that almost 90% or thereabouts of private capex this year is AI related capex. And you wonder how long that can go on. So at any point, if the run rate of that capex were to slow, that will also start to show in aggregate demand in the US, or headline GDP growth rate of the US. And that's another thing that people are watching for. And a fourth point is that even though Fed rates are still relatively high, aggregate financial conditions in the US are actually not that tight, because equity markets are at an all-time high, credit spreads are quite low, and typically refinancing is progressing at a reasonable pace. So it's a very complex economic situation in one way. However, the crux of the matter probably for now is that the Fed is more and more worried that if firings were to begin, then unemployment rate can quickly climb from here. And probably the one big variable they are looking at, therefore, is the unemployment rate, not so much the job creation. And if that rate were to climb, then you will find the next set of rate cuts happen pretty quickly. On inflation, although the pass-through of higher tariffs to final goods and services prices is not happened fully, many people estimate only around 30% pass-through has happened so far. So therefore, automatically inflation will rise in the future, but the Fed seems to be making their peace with the idea that it's a one-time hike in inflation and it won't get passed into second order because the end aggregate demand is relatively weak. So all told, a market expects the Fed to continue to cut. And our sense also as of date is that they will continue to cut. Although one thing you have to remember there is that financial conditions in the US are not tight, and therefore they are cutting rates to address one specific problem or two specific problems, which is the relatively frozen housing market and the relatively frozen labor market. The rest of the aggregate economy seems to be doing fine. The other piece that one has to think about is China, where first half was quite strong because the US upfronted a lot of its imports ahead of the tariffs, and therefore the exports for China were quite strong. Also, a lot of government fiscal measures, etc., were taken in first half, which held up GDP growth rate. But second half is looking much weaker. So the housing market seems to be sliding back. Inflation seems to be flatlining again. Consumer expectations seem to be weakening again. And therefore, if you see the aggregate shape of the world, it is one where growth is not very strong. And in that kind of a setup, you can't be too bearish on bonds as well, because it's not a re-accelerating economy yet. It's not, where you need to be worried about inflation or any sort of rate hikes anywhere in the distant future. And therefore, we continue to believe that it's too early to think about end of cycle. It's too early to go and say, let me receive credit spreads and just sit on them. You still have to be, fairly exposed to interest rate risk. Although, like I said before, not to the extent that you would have before. And especially given the last few months where investor behavior has been very defensive with respect to fixed income, uh, it's probably time to just scale up into the next bucket, provided your investment horizon and risk appetite allow for it.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.